Okay, good morning. Thank you for joining us for today's coffee talk. My name is Sean O'Brien, President of Quick Rate, and as always, pleased to be joined by Steve Huntington. Steve, you want to go ahead and introduce yourself?
Yeah, morning, everyone. Thanks again for spending some time with us on a Friday to go over CECL. My name is Steve Huntington. I'm the Director of Analytics here at Quick Rate and Quick Analytics. I've spent my whole career working with community financial institutions, everything from strategic planning, valuation, M&A, capital, and model design. And I've been working with Sean here at Quick Rate for just a little over a decade now.
Great. Thank you, Steve. Just a reminder, you can hit the Q&A box or chat to submit questions throughout. We'll monitor those and try to take sure we get all those addressed. We will send out a link to today's recording as well as a copy of the slides, so no worries on that. Again, what we want to do today is, one, congratulations on everybody kind of getting through the first quarter, getting that first filing completed. We want to talk today. We know we've made a number of changes to the tool. We'll probably continue to do that, so we want to touch on some of those again. Certainly take any questions that all of you might have. But we do want to start with just a few polling questions. I think this will probably become a staple for each month's coffee talk, but just again, trying to stay sensitive to, not only the kind of the evolution that's probably inherent in this process. We want to be sensitive to updates, but be sensitive to also just continuing to improve the tool and better educate you on how the different flexibilities that might be available that you might not have noticed. So with that, we're just going to start with a few polling questions. I think there's just 3 today. The first one is we get asked quite a bit, how many of us have been through an exam or an audit? So we just thought we'd again kind of touch base on this throughout the year. We'll just give this another 15 seconds or so. And I think kind of the answers are kind of coming in the way we'd anticipate. The majority of you are not have not been through one, so we'll end this one. 91% of you have not, and 90% of you have. Again, this is a 2023 event, so it's likely it'll become a bigger issue in 24. But as we can even see here, certainly some are being asked about it. Again, previously in discussions with the NCUA, and I think what we've seen kind of consistently throughout from the regulators is they are really more on a fact-finding mission. They want to make sure credit unions are working on this. They have something in place, but they indicated they're probably not going to be terribly critical of the tools this year. So we'll continue to monitor and share what we learn. The next question is, do you anticipate further increasing your reserve over the course of 2023? So again, we asked this last month. We'll probably continue to ask it throughout the year, just kind of trying to keep a sense of how everybody's feeling about their portfolio and just where their reserves are. Okay, so we'll go ahead and end this one. Where 65% of you are anticipate further increasing, 35% no. So thanks for sharing that. And then the final questions around enhancements. As you all know, we added quite a few enhancements here over the past 3 to 6 months. I suspect we'll continue to do that with feedback from all of you, but we wanted to ask, in terms of our pace of those, would you like to see those enhancements made more frequently, less frequently, or at the current pace that we are introducing them? Again, we do discussed quite a bit just how quickly we should roll out changes, because we are sensitive. We want you to be comfortable and confident with the tool, but at the same time, if there are improvements that either users have suggested or we think based on what we're hearing and seeing will help, we want to be sensitive to get those out to you as best possible. So again, thank you for submitting those. The answers, 81% are good with the current pace, 10% less frequently, 9% more frequently. So thank you all very much for answering those. One final question, and you can just submit this in through the chat feature through today's thing, is, if there's one thing or two things you'd like to see us improve about CECLSolver, the product or the service, you can just submit those or email them to us afterwards. We just thought this might be the best forum while we're thinking about it, talking about it, to get, any thoughts or feelings you might have on, immediate or suggested long-term improvements to CECLSolver. So with that, let's kind of jump in. As we've mentioned, we did make a number of enhancements and updates over the past 3 to 6 months. I won't go through all of those here. You can see them on the screen. But some of the larger ones we do want to have Steve, kind of go back through. We've touched on this in previous sessions, but I think now that we've had a chance to exhale, get through that first quarter, we can start to, kind of refine and, try to continually better understand all that's available to you in CECLSolver. So Steve, I'm going to let you take it from here.
Yeah, so I want to briefly touch on those 2 more recent enhancements that we made to the tool. Both of them very much based upon interactions and feedback that we've had from users in the past. After sort of reorganizing some of the calculations in the tool to more closely follow what we actually had to deal with on our call reports, now that we're kind of having to report CECL and not just think about it conceptually, right, but plug it into the balance sheet and the income statement and everything else. We had more requests for kind of a short and sweet summary page that would just show some of the more important outputs of the scenario of the tool, and then compare them to a previous quarter so we can see, kind of track very easily how our reserve and whatnot is changing. And then a couple of visualizations as well to see some trends for your institution and for the peer group. So that's what we did in our summary page. And in a minute, I'll share with you online on the interactive tool here. We'll go through it briefly to see what's on there. And secondly, the look back period options. We had a lot of situations with users where there was, they wanted to have some more flexibility with the look back periods. When we initially designed the tool, we made a universal assumption to keep it relatively straightforward and simple from a math perspective so that everyone could conceptualize what we were trying to accomplish with CECL. And so we matched or mirrored the length of the look back periods to the WARMs. That's still a completely appropriate assumption to make, and probably what most of you will continue to do in most, if not all cases. But there are certain circumstances where an institution would want to take into account a longer period of time historically than the WARM would account for in their analysis of their historical losses that we then will project forward to expected future losses. Some institutions out there were relatively newer credit unions that didn't have a lot of good historical data, and we needed to take a different focus and approach on the more limited historical data set that they did have to get appropriate calculations. So some different reasons that we'll go through as to why it might, when and where it might make sense to utilize some of these in kind of additional functionality or flexibility with the look back periods. But I expect for the majority of you, they will stay as they have been, or be used as they have been in the tool in the past. So why don't I go ahead and share my screen now, Sean, and
all right,
we'll start looking at these. All right, so what we've got here is, this is just a larger credit union in the Midwest that we have as our guinea pig for today. And this is the summary tab that opens up when you first open up a tool. If I head over to the loan portfolio summary, this is what would have what used to show up kind of by default this is a relatively summarized calculation for the loan portfolio, which is the vast majority, if not all, of our concern for ACL for most of you on the call. But again, this is as we've added some bells and whistles and nooks and crannies to the tool, this is starting to get a little bit more dense, so to speak, in a lot of numbers on here. So we wanted to add this summary page. What the summary page shows here, these are the outputs, the most recent period or the current outputs of the tool. So what you see here, these aren't overridable. These are simply what the tool, the outputs of a tool are. So in your loan portfolio, if you calculated your ACL to be 8.6 million, then you go to the summary and you'll see that's just a link to the output to the tool. This is the current balance of the portfolio as stated on the loan portfolio page here as well. And then we have a couple ratios and we pull in any data from the held to maturity securities. These guys don't really have any, so there's a bunch of zeros there, which is going to be standard for most of you as well. And then a summary of the numbers from the unfunded commitment section of a tool as well. So all just kind of summarized right here. And then the last period is just the most recent call report period before this one to get some sort of a comparison for between current scenarios on the left here and then a previous quarter to see change in reserve, change in balances over that period. By default, it's going to be the most recent call report period before this one. So you'll see a quarterly change. If you're doing this quarterly, let's say you're doing your scenario right now as of 3/31 and it pulls in 12/31 call report balance for the previous period, you can just see that change over a quarter. These are all blue, so they're all overridable. If you're doing this on a monthly basis, right? We don't have access to that monthly data because it's not public. So you might plug in your balances from, let's say, February 28th. If you just want to follow it for the month of March, you'd come in here and say, hey, just for reference, I want to remind myself that I'm looking that this data that I'm going to plug in here is from February. So I'm going to type in 2/28/23. That's just for my reference. And then I'm going to override these values with my February 28th balances and calculations. So you can override these. And again, this date would just be for your reference. By default, it's an older call report. But if you want to compare this scenario to a scenario you did a month or a quarter ago in this tool, you can open up that scenario and see what the values were and then plug them into here. So you get some sort of a comparison over time. And then down here, we put in a couple visualizations so that you can see your how your value has trended. Again, public data on the call reports and compared to the peer group. So here we see for this particular sample credit union, their reserve level has been declining over the last 6 quarters and even declined in the first quarter under CECL. So they had an excess reserve under when they did their one-time adjustment, and versus their peer group being for them of a larger credit unions in the western part of the country. So the western region, and I think over $500 million in assets is that group. But you did see a jump in reserve levels. This is something we all expected to see. We're going to talk a little bit. We're going to look at some industry data a little bit, and so you can see what actually happened to reserve levels around the country for other credit unions like you. And we certainly did see an increase in average or median reserve levels around the country, but not to the extent that many had anticipated. I think that's the easiest way I could summarize it. We saw, a 10 basis point jump, right? From 57 basis points to 67 basis points for that particular NCUA peer group in the first quarter as a result of transitioning to CECL. So that's kind of a summary of the summary page. Sean, any more discussion on that, or should we dig into the look back periods a little bit?
I just want to make a couple comments. One, just a reminder again, anything in blue in our tool is a field you can override. So, again, that is there for you. And then, again, just the pure data down here, we're just trying to give everybody a sense of where other credit unions are. So,
and the dates
no.
are critical to plug in, right? Because this is a question we get a lot from users is they'll come in and they'll say, I didn't want to compare it to the last call report. And I'm not doing this monthly. I wanted to compare it to a scenario I did a couple months ago to see how much it's changed. And so they come in here and they'll type in the balances from that last scenario so they get an accurate change. But then they'll just leave this date here because, the date doesn't change automatically. I'm not going to worry about it. And then they'll just save this scenario. And then 2 months later, they'll come back in here and say, well, these balances are not from this date. There seems to be a mismatch here. It's because a lot of times, not in all cases, but in a lot of cases, because somebody, a user updated this data to be as of another date, but then didn't go ahead and actually update the date as their reference point so that they know that it matches apples to apples.
Yeah. Steve, we did have a couple of questions. Maybe we can jump on. So the question was, where should we be putting current charge-offs, or do these just go into the individually assessed loan area? For example, we have 2 loans that just charged off in April. How do I account for these within CECLSolver? Or will this just update within the next call report update?
So it depends on when you're doing an analysis as of, right? The tool calculates your reserve, the reserve you need as of a specific point in time. It's not over a period of time, right? We're not, and a charge off is a historical value that accumulates over time. If you're calculating your reserve as of, let's say May 12th, we're going to do a calculation as of May 12th. Right now, the historical data is updated as of March 31st. If you had a charge off at some point in April, and now you're doing a reserve calculation in May, you're still gonna, the calculation from the tool is still going to be accurate because it's telling you what reserve you need as of May, not how you got there between March and May, right? If you had a charge off, then that's fine. You had a charge, that's going to inform what provision you need, right? To get to the reserve level, the new reserve level that we're calculating. But if your reserve was $1 million in March, and now this tool tells you your reserve needs to be $1.2 million in May, and you had a $200,000 charge off, your provision needs to be $400,000, right? Because you took $200,000 out of your reserve to cover your charge off. And now your reserve, this tool is telling you as of now, your reserve needs to be 1.2. So the question of where do charge-offs go in the tool, they don't go into the tool as part of the calculation of the reserve as of a specific point in time. They go into your calculation of what provision you need on the income statement to get you from your last reserve before these charge-offs to your new reserve post these charge-offs, right? The only time that would be part of this tool was if you're looking at your historical analysis, right? And you're trying to get and you're calculating, you're using your historical loss rate as a proxy for what your expected future loss rate is going to be. So if you had a large charge-off that was, let's say, in April, and this historical analysis is only taking into account your loss experience through March, right? You don't have to take into account that charge-off in April as part of this part of the analysis, unless you think it is out of the ordinary or changes your future expectation of loss, right? The only thing we're using this for, your historical experience, is just used to help project your expected future losses. So if that loss is outside this context and you think it suggests that future losses are more likely, then you need a Q factor adjustment to say, hey, my historical losses of 1% don't reflect what I expect in the future because I just had a recent charge off that's not included in there and I think more are coming. Or vice versa, we had a charge off and it really cleared out that portfolio and it's clean as heck now. I think the historical losses are overestimation of what I expect in the future. That would be a negative qualitative factor adjustment that you would say, to account for recent charge off that cleaned up portfolio, however you want to manage that in the Q factor process.
Great. And then the next question, is there a way to copy notes from one portfolio summary to another scenario? We don't really have that feature yet.
One portfolio summary.
Just if you had notes in one of your scenarios to forward it to another scenario.
No, I mean, no, you would literally, you do your control, your copy paste thing, for these. If it was, so I guess the one thing I'd want to make sure is, if you build a scenario, if you have one primary scenario that you're using, right? Maybe you're doing a little bit of stress testing or you're playing around to see some other stuff, but you have kind of a primary scenario that you're doing your calculation off of each quarter. When you come in the next quarter, you should be updating that scenario and then saving it as a new one, as opposed to creating a completely new scenario from scratch and then trying to copy over all the work that you did last quarter. So I think that's an important, and that's something that we have in the slides here further on, Sean, is the process. What are best practices for using the tool over time, right? And certainly you could come in here each quarter and start a completely new scenario from scratch to say, you know what, I want to make sure I didn't build in any overrides that were inappropriate or anything gets hidden in there that I forget about. I want to start from scratch each quarter. You can do that. It's certainly a lot more work than you probably need to do. The tool was designed so that you pull up your last quarter's scenario with all your notes, all your Q factors, all your individually assessed loan details and tweaks and everything else. And then you can update that old scenario with newer historical data. You can go to the historical page and see that the most recent quarter is dated and that there is new data on that tab that's not being taken into account. You can flip it so it does take that into account. Then you can update your current balances here, and then you can just check your Q factors, check your notes, change them any way you see fit. And then the most important thing is do not click resave. You don't want one scenario that you're using forever. Every time you have new data or a new date that you're doing it as of, or new peer data or anything else, you want to save it as a new scenario, because you want to have this historical reference, right? This historically accurate, frozen in time reserve calculation, so that a year from now you can go back and say, well, what were we doing a year ago? How do we come up with our 0.75%, or what type of adjustments were we making a year ago and how does it compare to now? You can roll back, click on the drop down box, click on your scenario from a year ago, and then compare and contrast it apples to apples with this quarter scenario. So the best practice is to pull up your last quarter scenario, update financials, modify anything that needs to be modified, update notes, double check everything, save it as a new one, give it a new name and a new date, right? Say, primary scenario Q2, and then 3 months from now, you open it back up, open up the Q2 one, change it, and then save it as new and call it Q3, so that you're not copying and pasting all your work from one scenario to a completely new from scratch scenario. Not sure if that was the question, but I felt like that was kind of where.
Well, I think that was part of it, but I think
I was leading the witness. I know.
Yeah, I think it was more specifically for the notes themselves, and so I think those are just right now. We don't really have a convenient way to.
No, because they were designed to follow along as you say, as you continue to use the old scenarios, modify them, and then save them as new. The notes would come along each time.
Yeah. The next question was, and I think this leads into probably where you're going next, Steve. Does the historical look back at the last 3 years, and is this a rolling 3 years? So again, it's really more of a question, just, it's based on the WARM and how you want to evaluate it, but it does also kind of lead into the enhancement we made, or you made.
Yep. So by default, our tool uses look back periods that end at the most current data, right? So we're not, by default, we're not choosing, a 3-year look back from 2014 to 2017. All of our look backs by default are going back in time from today. You can certainly modify that if you didn't want to take into account the most recent quarter for some reason, or you wanted to do an analysis as of, let's say, last year end, and go back in time and say, hey, if this was still 12/31 and I did this analysis, what might it look like? You can roll the clock back and do this as of a historical period by literally rolling the clock back for the whole portfolio. If I were to do this here. So what I just did is across the board said I want all my periods to end, all my lookbacks to end at the end of last year. So effectively, I just said I'm ignoring everything that happened in the first quarter across the industry and with my historical experience, and I'm doing this as of 12/31. at least from a historical loss rate calculation. So that flexibility has always been there. But what the newer flexibility is, and it's a good question to lead into it, as Sean mentioned. I'm just resetting that assumption because that's a weird one. If I scroll down to the bottom of the historical page here, you'll notice there are a couple new columns. You don't have to utilize them, right? The tool will still work as you have used it in the past. It'll still, by default, if you have a 3-year WARM, it's going to use a 3-year look back period that ends at the most recent call report data. That's still the case if you don't change anything. However, now you have the option to say, hey, my mortgage portfolio has a WARM of 5 years. But in the last 5 years, I've had almost no losses at all. And so my entire reserve for my mortgage portfolio is coming 100% from my Q factors. That's kind of exhausting. And every single time I have an audit or an exam, it's this huge narrative around why I keep seeing zeros for my historical and 100% of the reserve is coming from Q factors. Now we have another tool in our arsenal to contend with that. You might say, all right, the WARM is 5 years, so I need a 5-year loss rate, but I want to take into account 12 years of historical data. I want to take into account the last credit cycle because I think that that's relevant to what I think losses will be in the future. Now I can come back and say, you know what? I'm looking back here and I see, yeah, we had some losses way back in 2010, 11, 12, we had elevated losses and they've been negligible pretty much since then. So now I want to take into account all the way back to the beginning of 2011. So now I click on the beginning of my look back period, and now I choose the beginning of 2011. So now my historical long-term loss rate is taking into account all the way back to 2011. So now I have this aggregate losses over look back of 12 years worth of losses. Now that's not the final number because I still have the remaining life of this portfolio. I've calculated the WARM of 5 years. So my future expected loss rate has to be based on my expectation of 5 years worth of losses. So now we have to add some math, right? Because now we're looking at 12 years worth of data, but we need to estimate 5 years worth of future losses. So we added a new column called a lifetime look back multiplier. So for those of you who want to have a different look back duration than your WARM, you can do that now. And we add some additional math to make it still appropriate lifetime loss rate. In this case, it's 0.41, right? Because we have 5 years worth of WARM, but we have 12 years worth of data that's being jammed into it. So now we're multiplying that 12-year loss rate by 0.41 to get a 5-year aggregate loss rate. And that's going to be the typical use case for this additional flexibility is mostly to be expanding or extending look back periods to search further back in time for more losses, honestly. But there are certainly use cases that are the opposite. Let's say that you had some financial difficulties your credit union did in 2017 and 2018, and then you had a big management change, right? The whole management team was doing some sketchy stuff. They were all given the boot. You've got an entirely new management team and underwriting staff starting in 2019. So your argument is all those losses that we had in 2017 and 18 are not indicative of what we expect moving forward because of this big organizational change that we had. That's when you might say, I've got a 5-year WARM on my mortgages, but I only want to take into account the last 2.5 years of loss data, right? Because of that change that makes older data not reflective of what you expect. Then you'd do that calculation of a 2-year loss rate and then multiply it, or 3-year loss rate, then you'd multiply it by more than 1 to make it equal to a 5-year aggregate loss rate. So there are use cases in either direction. It's probably mostly going to be to extend it. Well, I'd say the most common use case is that you're not going to do this, right? I think most of you on the call are not going to start going in and subjectively changing every single look back period by a quarter here or a quarter there, because you'll have to justify all those changes and assumptions. And I don't think it's usually worth it to do so, but there may be a case or two that makes sense to use a really long look back period if you're trying to capture some older losses, or a shorter one if you're a de novo institution, or have something else changing more recently in the bank. Sean, or in the credit union, sorry, Sean.
Perfect. No, that's great, Steve. So do you want me to take back to the slides now?
Yeah, I think so. And then I'll pop back onto here as necessary.
That sounds good. All right. So let's grab back the slide deck. So as Steve touched on, right, we just he went through the summary page, which we hope you find helpful. We talked through the new, kind of flexibility with the look back period, which again, I think as Steve pointed out, but I want to reiterate, you don't have to use the new tool. I think the idea is that, as Steve touched on, for many of us, we might have had a benign recent credit period, but when we want to think about our future reserve, we want to really kind of take a longer, more totalitarian kind of look at, good, bad, and ugly, and then still use it based on our current WARM. So it's a degree of flexibility we thought you'd like, but again, you're under no requirement to use it.
And that might be driven by your own preference that, you every time you're having an audit or an exam, there's so much pushback on all these Q factors that you've used, and you'd rather take a more extended cyclical view of the historical losses and put a little bit less burden on the Q factors to be coming up with your entire reserve, or vice versa. If you may have a situation where an examiner says, you're taking into account 12 years worth of losses. You really think what happened in 2011 is relevant to what you think is going to happen next year, and then that may be a problem on the other end. So you may, so there's, again, it's just providing additional flexibility if you want it. If you don't, you can pretend you didn't hear the last 10 minutes, and the tool will keep doing what it's always done.
Perfect. All right. So next up, just the unfunded commitments. Again, this is an area that it's a requirement. So, we obviously, most credit unions, were not doing this type of analysis in the ALLL because it was optional. We built this in a way to just give you a framework to think about those, as that is the requirement, that you analyze these unfunded commitments, which again, as we've discussed, and you recognize, are not loans yet. So this was a framework that Steve developed for us to just give you a way to think about them. If you're doing something currently internally, that's more than acceptable. But again, we just wanted to provide a framework. There's been no prescription by regulators or auditors on how credit unions should handle these. So again, we were really just trying to give you something to get the conversation started. Steve, anything you want to touch on here?
Yeah, well, a question just came in, which is relevant to the unfunded commitments. And I guess everyone can see that, but the question is, for unfunded commitments, the credit on the balance sheet is in other liabilities, but where is the debit? Where is it on the income statement is what we're talking about here. And yes, it's a provision expense. So the only things coming into and out of that, it's your loan portfolio reserve is a contra asset account on the asset side. The unfunded commitment is just a standard liability. It's not a contra anything. It's just a liability account. And the only things that come, whereas you have charge-offs and recoveries and provisions going into and out of the loan loss reserve, right, on the asset side for the loan portfolio, the only things coming into and out of the unfunded commitment reserve as a liability are just your adjustments to what you think that reserve needs to be, right? You're not having charge-offs coming out of you're never going to have a loss on your unfunded commitments. It's not possible, right? It has to become a funded loan, and then you could have a loss there. So the only adjustments that are going to happen is whenever you reevaluate what reserve you need on the unfunded commitments, if it's higher than what you have now, you have a provision expense on the income statement that goes pretty much right where the loan loss provision expense goes. And then that increases the liability account on the balance sheet, and vice versa. If you go in next quarter and your analysis shows you need $500 less in there, then it's a negative provision. And then it gets added or, removed from the liability account. But back to the general concept here. Again, they haven't been very prescriptive on unfunded commitments. We haven't gotten a lot of really good guidance. The initial CECL standard and then a lot of the follow-up interagency presentations and documents that have come out have been relatively thin on exactly how the only thing they've said is they've all universally agreed that you have to at least do an analysis to see if you think you need a reserve on the unfunded commitments and then what that might be, right? It's all one or two levels of hypotheticalness in nature. Because again, we're never going to have a loss on that. It'll become a funded loan. And then at some point in the future, you may have a small loss on it. And there's also no expectation from the regulatory or accounting side of exactly what that number would need to be. Probably not zero, but there's not like we have 20 years, 50 years of built up data suggesting that, well, your peers are at 50 basis points here. You need to make sure you're around there, one way or the other. So there's less reverse engineering a specific unfunded commitment level because we don't have all that built up expectation of what it should be. All that being said, we wanted to at least provide some sort of framework to get you on your way because we knew that they were going to be expecting some sort of analysis. And that's how we developed the tool that we have here. It's certainly, we've worked with the NCUA and FASB on the assumptions that we have, or on this framework and why we do the math the way we do. But it just requires you to come in, make some assumptions about, or not assumptions, but do some checking on your contract to see what is unconditionally cancelable. If you can go to the previous, the total unfunded commitments, we can get those values from the call report each quarter. And then what of those are unconditionally cancelable has been I won't say a moving target, but unconditionally cancelable does not have one specific exact universal definition. That would be way too easy, right? You got the regulators who have a more broad definition of it, and you've got the accountants who are increasingly having a more strict definition of it as it pertains to CECL. Unused credit card lines are the definition of unconditionally cancelable. They're always, all the time. That's the one thing I can say for sure. HELOCs depend upon how your contracts are written. The regulators more lenient there. The accountants more strict and more apt to tell you they're not comfortable with you backing out your HELOCs as unconditionally cancelable. But you need to look at how the contracts are written and get a legal determination of that. Overdraft protection commitments, pretty close to almost always being unconditionally cancelable, but those are very universally written in a way that you or the customer can sort of back out of those as needed without a bunch of legal hoops. So that's your first hurdle, right? Determining what's unconditionally cancelable. It's important because we don't have to worry about CECL for any of those amounts that are unconditionally cancelable. Don't skip over this step because you don't want to go through the work. It will in the long run remove some of this burden on a permanent basis for you. Next step is the probability of funding. This is another very arbitrary, very subjective value here. The guidance, the starting point that we gave you comes directly from some language and research that was done by the NCUA. If you read, I don't suggest anyone do this unless they have to. If you dig really deep into the risk-based capital sections of the 5300 of the call report, there's a discussion in there from the NCUA where they did some analysis of what they call credit conversion factors, or CCFs. That's kind of their definition of how likely unfunded or unused lines were to become funded or used within a period of time. That's our starting point. That's a good starting point. Anything beyond that is going to involve you looking over, you tracking historically the usage of your unfunded commitments over time. And most people don't have that kind of data readily available. And there is no industry standard for that, unfortunately. The NCUA was kind enough to give us some guidance on warms and prepayments late last year, which has been very helpful. But otherwise, I kind of see the probability of funding as an assumption, kind of like prepayments for the warm calculations. Pretty nebulous, somewhat arbitrary, certainly subjective, and probably need to be based on your historical experience to some extent, unless you just want to use the guidance that's out there. So I suggest to everybody, start with what guidance is out there, and then enhance it, spend more time tweaking it if and when you're required specifically to do so. Next step is the average remaining commitment length. So this is like a warm calculation, but it's for your unfunded commitments. But it doesn't have to be as complicated as that, because in most of these commitment letters, in most of the legal documentation for these types of unfunded commitments, there's some language about them being annually renewable or at least reviewable. And the hurdle that you have to meet for these calculations for CECL is the length of time that you are legally obligated from today to extend credit. If you can renew or review that on an annual basis, your legal obligation stops a year from now. Your guaranteed legal obligation, right? And so that's why we start for 1 year as a kind of a blanket assumption for that value. That's not always going to be accurate. We don't have any better data to go on that's publicly available than that. That's why we start there. And then finally, the expected loss rate. You're not going to have losses, again, on your unfunded commitments, but if they become loans, you may have some losses on them down the road. And so we look at your losses on the loan portfolio and the analysis we just did on the whole, on the loan portfolio summary there, and we derive annual expected loss rates on the unfunded commitments that are based upon the loss experience you've had with your actual loans, which is where it should come from. Now, this is again a starting point. The number of unfunded commitments you have in these buckets is not going to perfectly match what the average loan from your entire loan portfolio has experienced. But there's no better data that exists than that in the public sphere. So this is, again, a starting point. You want to look at those contracts and think about, how do I think this would act as a loan if it were to become a loan? Look at the loss experience that similar type of loan has had and make it and make an assumption or a guess here as to what that loss rate might be on the unfunded commitment were it to be funded. So we give you a good starting point, but this is all a template that, is based upon less than perfect guidance to give you a good road to head down. And this will likely be improved, enhanced, added to, especially as we go through this year, right? We always knew that once we wouldn't have a lot of additional detail here until everyone was living in a CECL world and going through audits and exams under CECL. That's when we would really start hearing from the auditors and the examiners. Once they're being forced to think about it with real world data, what do they like? What do they expect to see? And once we see that in a preponderance of, we have a lot of users now. We have hundreds of users using this, which is great, which means we have a lot of potential data coming in as to all those auditors and examiners and what they're going to like and not like and want to see different. That's when we'll make changes to this part of the tool if we need to, based upon things that, now that we're living in it, they want to see done differently going forward. Sean?
Yeah, Steve, we got a question that came in about the average remaining commitment. If it's something we commit to review annually, should we reduce it by 25% each quarter, or should we leave it at 1 all year for the?
Well, for each individual commitment, it's between now and whenever that renew date is. So that's why you have to look you really have to look at the maturity date or the review date of that individual loan level or commitment level value, and then say, hey, we got $100,000 unused line that renews or reviews in 6 months. So the remaining length of that one is 0.5 years. So the only thing you can do to really recalculate this is have your own spreadsheet of those unused commitments and do a calculation of what between now and when that review date is.
Yeah, and that's where, again, I would advise against going down too big a rabbit hole.
Diminishing returns.
Totally, right?
Yeah.
So you're right. I mean, I think that's the balance we were trying to get. This is required, but these are loans that don't exist yet. If they become loans for you, they're going to show up on the loan portfolio summary. As Steve said, you're never going to take a loss here. The requirement is that you evaluate these to determine whether a reserve is necessary. I would keep it pretty broad and high level, because the reward for doing extra analysis, in my opinion, very, very low. Right?
It's extra scrutiny, actually.
Yeah.
A lot of times.
Right. You're just going to invite extra scrutiny for, again, nothing materially to benefit you. So just be sensitive to that as you. If
they dig and require more, then we have to provide more if and when that happens. But I wouldn't be the one to go a whole nother level of detail on this, because once you provide it, guess what? That's the new expectation forever. Yeah. So I wouldn't lead them down that rabbit hole until they require it.
Push you. Yeah. Amen. Yeah. Amen. Okay, so we covered this. You want to talk about updating scenarios real quick, Steve?
Yeah, sort of. I guess I already did that to an extent, but again, the tool is designed to allow you to save a huge amount of time each quarter by not starting a new scenario from scratch and trying to import all your old data or all the old assumptions that you want. The idea is you pull up the old scenario, you make lots of notes. The notes that we make on our scenarios are not just for the audit committee. They're not just for the exam preparation. They're for your recollection next time around, why you made the assumption, the input, the Q factor adjustment, that you did, right? So points for paper, not just, to get you through an audit, but also to remind you next quarter what you need to look at and what you were thinking when you made this assumption last quarter. But you pull up your scenario from last quarter, you update the warms, maybe, right? How often are you recalculating your warms? Are we doing it for you quarterly? Are you doing it for yourselves quarterly or semi-annually? There is no right answer, of course. Everything's subjective here. So are your warms, are you doing it yourself quarterly? Is it a large burden of your time? Are they changing by like 1 basis point or 2 basis points each quarter? That's not worth your extra time or energy to be renewing that entire warm analysis if they're changing by rounding errors on a quarter to quarter basis. That's when I would say, you know what, I'm gonna do this semi-annually and force them to ask me to do it more often, right? But the starting point is probably quarterly. So update your warms, meaning plug new warms into the tool from your old scenario, then go update the balances, the current balances as of the new quarter or the new date as of that you're doing it for. Then go into the historical tab, roll that data forward to include the most recent year if you'd like to, or the most recent quarter if there is new peer data. And then revisit your Q factors. Go into your already completely set up, notated, detailed Q factors page, go through them and what needs to be modified, what needs to be different than it was last quarter. And then do the same thing with the individual assessments and the unfunded commitments. And then do not resave that scenario. Save it as a new scenario with a name that allows you to know why it's different, right? New date, new quarter, new whatever.
Perfect. All right. So Steve went ahead and put together some just trends we thought you might find helpful. This is again an area where we hope to, kind of build out a little bit here and share with you each quarter as information becomes more available. So this was our first kind of go this quarter just to grab some high level industry trends on where credit unions have their ACLs. And so again, Steve, if you want to take it away here.
Yeah. So we were as curious as you guys were to see what actually happened in the first quarter with reserve levels for credit unions around the country. So not to be exclusionary, but I just randomly chose peer group 5, which are the $100 to $500 million. There are almost exactly 1,000 credit unions in the country that are between 100 and 500 million total assets. So it was a good group. And we looked at, I pulled the last 5 quarters worth of reserve levels for all 1,000 of them and calculated a 10th percentile, a 25th percentile, a median and a mean, a 75th percentile and a 90th percentile. So we could get a range. You can see here for the asset group, obviously 10th percentile in assets is going to be close to the $100 million range, 90th percentile close to the $500 range, and the median in the $200 million range. We saw reserve levels at the median starting at the first quarter of last year, 53 basis points, 50 basis points, 50 basis points, 50 basis points, and then boop, first quarter, 62 basis points. So on average, that was the jump that we saw in reserves due to CECL. About a 10 basis point on average jump in reserves around the country for $100 to $500 million credit unions. My guess is if I did peer group 6, everybody over 500 million in assets, the bigger credit unions, it probably would have been a bit of a larger jump. And if I looked at 10 to $50 million credit unions, probably a slightly smaller jump. We just saw bigger increases in reserves for bigger institutions. It's just something we saw across the board with commercial banks as well. But it's so, yeah, we were seeing increases for all credit unions on average, as we all expected, but there was no doubling of reserves or 50% increases. These were 5, 10, 15, maybe 20 basis point at the most increases in reserves. So I'd be curious to see how that compares to what everyone expected to see in the first quarter. And we'll be interested to see how that changes in the second quarter. If there's a readjustment or an additional increase after people did their first quarters, or if it stays kind of flat again after we got that one bump in the first quarter. If everyone took the opportunity to take that hit, right, the one-time hit outside of the income statement, and utilize that opportunity to do so, or if people decided to kind of work their way into it. So it'll be interesting to see what happens.
Great. Just checking a question here now. Alan, we'll take into account or take a look at this just about trying to put together an index document. So we'll take a look at that and try to incorporate into future coffee talks. Thank you for that. Okay, so I think that's our presentation for today. If there's any additional questions, we'll certainly entertain them now. Next month we do hope to have another guest panelist joining us, so we'll work towards that.
Oh, and also I want to jump in on that. I just finished reading that question there. As far as timestamps on the thing, so to kind of provide just a little table of contents from the webinar for the coffee talk as it pertains to certain topics or questions. It's a great idea. We will look into how to do that and how to provide that along with the presentation at some point. I'd also, if you hadn't seen our coffee talk last month, was a lot of Q&A, and then we followed that up with a Q&A document that had a lot of specific questions and answers to it. We are uploading that Q&A PDF to the CECL resources tab. I think it's already there. If not, it'll be there on Monday from a couple weeks ago. And so if you had a specific question that you're looking to see a little bit more on, you could also look at that guidance for reference. But this is a great idea to sort of timestamp some of the topics that we discuss here. I just thought everyone would just want to rewatch the whole hour every time they wanted to hear me and Sean and our smiling faces ramble on about stuff. But I guess I've been disavowed of that.
We're happy you join us every month. So we'll work to see what we can come up with there on a more consistent place. Appreciate the nice comment there, Nancy. So again, thank you all very much for your time today. Again, we're going to try to, we'll continue to do these coffee talks all year. We're going to try to share with you what we hear, what you want. Again, thank you for the suggestions on enhancements. We'll try to keep that evolving as information becomes available, or time-saving tools, or just better ways to do the analysis. So again, thank you very much for your time today. Have a great weekend. And Steve, any final words before we let them all go?
Yeah, I think I'll take the opportunity to, I don't know if anyone noticed, my coffee mug for today is from the Carolina Hurricanes. I currently reside in Raleigh, North Carolina, and I am a hockey fan. So I'm sorry to anyone on the call from New Jersey. Well, that's not true. I'm not really sorry, but I understand your pain with the Devils being eliminated. But I just wanted to say, go Carolina Hurricanes.
All right. We'll continue to watch for the Hurricanes in the Stanley Cup. Thanks again, everybody. Have a great weekend, and we'll talk to you again next month.
Thanks, everybody. Yes, Hartford Whalers. Excellent. Just saw that come in. I appreciate the history.
Michelle, we'll have somebody reach out to you to discuss that.